The following is for informational and entertainment purposes only and should not be construed as financial advice. This discussion is a presentation by 1031, the leading institutional investor focused on the Bitcoin ecosystem. 1031 has over 10 years of experience in Bitcoin and has deployed nearly $150 million into the leading opportunities in the space. To learn more, visit 1031.vc.
Bitcoin Alpha, Episode 8. Gentlemen, it's good to see you.
Likewise. We're back again.
We're back. I think we've made the promise to the audience that we're only going to come back when we feel there's enough to talk about, enough alpha to glean from a conversation between the three of us. And it seems like a pretty good time. You have the long end of the yield curve over in Japan blowing out. You have elevated 10-year and 30-year yields here in the United States. There's deals going on over in the Middle East. There's Bitcoin Treasury company stock prices pumping. Bitcoin is back above $106,000. So it feels like a good time to congregate and talk about all this. John, you wanted to open with that clip from Treasury Secretary Scott Bessent. Why this clip specifically?
Yeah. A few things. I think it's an interesting rhetorical shift for the administration. And I don't think we've actually done an episode on kind of Liberation Day and the fallout thereafter. So we can kind of cram all that in. I think we were all kind of waiting to see how some of the early pieces shook out before we commented kind of at length. But it's interesting. It was interesting to me because kind of signals a move from kind of the big stick of we see this huge trade imbalance, this huge capital account and current account imbalance that the U.S. has with the rest of the world. We're going to, impose gazillion % tariffs on everyone until we can just kind of, with the big stick, enforce a new order in hopefully a quarter or two, and we can get into it. But it seems like maybe that's going to be a little more complicated than some of the administration might have been hoping. Although perhaps the chaos was the point. But it's interesting to see that the focus is maybe shifting a little more now toward the desire to just grow the U.S. economy, because that'll be, as to hear Bessent talk about it, the engine through which we get out of the debt burden that has complicated maybe the intentions that were coming out of Liberation Day. So, like I said, we haven't talked about it yet, but mid-April. You saw, the 10-year, which Bessent is allegedly focused on, getting down, rip from 4% to 4.5%. We immediately have to announce a pause on, the aggressive tariff plans because of bond market volatility. And lo and behold, now the goal is, well, we really need to get that debt and deficit down. How do we do that? Well, we need to just step on the gas for growth in the U.S. economy, which, if you've been watching Marty's show and if you've been following TFTC for a while and kind of the Bitcoin space for a while, you may recognize as the playbook that I think a lot of us have been expecting for a long time, which is let inflation run hot effectively, pump growth, get nominal growth above rates, have some sort of financial repression, whether that's explicit yield curve control or not, even if it's just, pump growth as much as possible here, and then kind of grow your way out of the debt. And it was interesting to hear him talk about that. After all, it's happened this month, on the heels of also a downgrade of U.S. debt from Moody's as they kind of mark to market what their peers have done over the last 10 years. So all that is just to say, I think that tells us a lot about where we are right now in terms of, what the administration's seeing, what's in the art of the possible. And, that has implications for a lot of the stuff that I think we'll want to get into today.
Yeah, as it pertains to Liberation Day, I think and whether or not it's structured chaos to incite a particular reaction from trade partners and markets broadly. I'm beginning to believe that we have a Mike Tyson situation on our hands, which is everybody has a plan until you get punched in the face. Because there's so many external variables that can really throw a wrench in the plan. I mean, we mentioned Japan. I think all eyes are in Japan today. But what I found was particularly interesting. I wrote about this in the newsletter last week. Everybody was focused on what was happening in the Middle East, and it was just interesting to observe the 10-year and 30-year yield, which reapproached the levels that they reached on the evening of April 12th. And I think it was just an interesting juxtaposition of the conversation around the 10 and 30-year yields on April 12th, which was everybody's hair was on fire. It was five alarm, like chaos. And last week, nobody was really talking about it. They seemed to be distracted with the Riyadh Accords. But I think this week, more focus has shifted towards the 10-year and 30-year, particularly as Japan's yield curve blows out, because that could have negative effects on the long end of our yield curve if the Japanese are forced to sell the massive amount of, not all of them, but a portion of the massive amount of U.S. treasuries they hold, which I believe is at $1.2 trillion right now.
Yeah. I mean, it's an awkward spot, right? And with interest costs now exceeding defense spending, with 10-year, like you're saying, up near like 10 plus year highs, this very awkward level. We've got Trump talking about his big, beautiful tax bill, which, probably on the margin increases, not decreases deficits. Department of Defense getting its first $1 trillion budget coming down the pike. Trump today told Republicans as they, navigate tax and spending, don't screw with Medicaid. So it's the CMS spending for healthcare in this country, massive line item. Okay, we can't screw with that. So that collectively, I think helps shed light on and frame up while other bond markets are blowing up around the world. There's not really, the options are kind of default, right? And just collapse all this and kind of take your medicine and move on. Or you power through and you tell Jerome Powell to look at, average inflation targets rather than kind of a particular fixed level. And, you just try to power through with nominal growth to get the debt burden down relative to GDP. And it's one of those things where the last 10 years has just been a game of the quiet part getting progressively louder. And it feels like that's another major moment of the Treasury Secretary basically saying in nice euphemisms, we're going to inflate this away. We're going to grow out of this. There's one thing that ultimately means. And it's, as you referenced with Japan, it's a global problem, right? So everyone's kind of staring down the barrel of that being the policy choice that they have in front of them.
Well, speaking of saying the quiet part out loud, that was the shocking thing yesterday coming out of Japan, is that you had the prime minister explicitly say we're in a worse financial position than Greece, which the Japanese are a very proud culture. They tend to hold things very close to the chest and project strength. And that comment alone it was shocking to me as somebody who's been following FX markets for the better part of 15 years. If you've been doing that, that the Bank of Japan and the Japanese prime minister essentially tied at the hip, and they try to keep a very, very sort of strong facade from a public facing perspective. And the fact that he said that yesterday was pretty mind blowing to me.
Yeah. I mean, so to pull in the senior member of the team who's had, the most experience of any of us with, carry trades effectively. Grant comes from a private equity background, as we talked about before on the show. And, curious, Grant, to get your thoughts on, we're coming out of like 15, 20 years of asset classes, including PE, probably PE most notably benefiting from kind of secularly declining rates on the margin, both from just leverage capacity and also, what that does for, growth at potential target companies. Seems like we're in a position where, whether it's like international carry trades, like, the one that has dominated out of Japan, or just the general, carry of, borrowing at meaningfully lower costs than you think you could reinvest at. as that kind of unwinds and we sit at this awkward spot of rates higher, a lot higher than everyone would like, and maybe going higher without some sort of like yield curve control type intervention, like curious how you look at just the spot that like all of alternative investing is like sitting in right now, with that headwind.
Yeah, I think, to me, the first thing that comes to mind is just that like all roads, we're talking about increased cost of capital across the board. And to me, all roads lead back to cash flow or to sats flow, in our perspective. For alternative investments, whether it's private equity funds or venture funds, a lot of the times investment returns were just driven from pursuing growth, but you also got the benefit of increased valuations because of the lower cost of capital, which manifested in increased multiples or premiums being paid for the same set of cash flows, or even not even the existence of cash flows, just paying for assets. I think in a world where the cost of capital is going up, you have to focus more on generating real profits with the capital that you invest, and you can't rely on your returns from increased multiples for the same asset that you're buying. Like usually what we would think of is when you would model out an investment in any business, you're putting equity in the private equity model. Some of that is financed with debt because theoretically you have cash flows that can service the debt, and that allows you to have levered equity plays. But you put in the equity, maybe there's some debt. Once you monetize an investment, there's a terminal equity value. Hopefully that results in some sort of gain. And then you can pretty easily, it's just a math equation on, well, what were your sources of gain? Were your sources of gain from growth in the underlying earnings of the business? Was sources of gain from the cash flow that you generated along the way, so that your net debt position or your net cash grew over time, so you accumulated more equity value effectively on your balance sheet? Or did someone decide to pay more for your business on a multiple perspective than what you paid for it? Those are pretty much the only three levers that you had that would drive equity value growth. And when you have carry trade dynamics like this, that manifests itself in people just paying higher prices for the same asset. So when that goes away, that leaves two levers of growth. That's generating cash flow and trying to grow your business.
Yeah. And when you apply this to like governments and you're looking at the debt they're taking out in the form of bond issuance and the revenue they're bringing in to try to pay that back, which is tax revenues, it's collapsing. As Bessent mentioned, 6.7% are deficits that we're running, and it looks like that number is only going up. And bringing it back to what is the public narrative that the Trump administration is putting out there, which is we're going to grow our way out of this. I'm finding it hard to believe that that's going to be possible when you look at the state of the American consumer specifically. And Logan, if you can pull up the newsletter that went out this morning, just diving into some of the stats, I think there was one anecdote from the headlines yesterday that came out. If you go down to the Klarna announcement, Klarna came out with data up right there, and basically that their credit book is taking on more losses. They have 100 million users leveraging their buy now, pay later services. And if any of you remember, we talked about this a couple months ago when Klarna announced their partnership with DoorDash. Since then, they've expanded their partnerships, but they've sort of moved down market from these big ticket items that have a longer payback period to fast food deliveries, which have a shorter payback period. And at the time, a couple months ago, end of March, I believe, I was saying like, this is a signal to me that their charge-off rates on the bigger ticket items are probably increasing because around that time, Discover and Capital One released information on their charge-off rates, which were reaching levels not seen since 2008. And so you can just surmise that Klarna is experiencing similar charge-off rates, and they're moving down market to sort of fill that hole. And it's becoming clear that that hole does exist as data comes out from Klarna. And then on top of that, bring it back to the U.S. consumer. Logan, if you pull that chart up right below that, mortgage rates, average 30-year mortgage rate is over 7% now at 7.04%. And so you have a situation here. And then if you go down one more to this section, the National Association of Realtors came out with data stating that the median age of home buyers hit an all-time high of 56 years old, up from 49 years old in 2023. So last year, the average home buyer was 56, or the median home buyer was 56. The year before it was 49. So it seems like the only people that are able to actually buy houses right now in the U.S. are old Gen X and boomers. And so when it comes to the growth narrative, we're going to grow out of this. I'd be interested to get your thoughts if you guys think that's actually possible, considering this debt backdrop of the U.S. consumer, which seems to be feeling the pressure.
I mean, I think it's definitely possible. There's no limit on stimmies that can be provided. There's no limit on the rates that effectively the U.S. government / Fed / Treasury can kind of manipulate and demand. There are a lot of cards to be played on, say, like the Fannie and Freddie side. There are a lot of, I think, cards still to be played on providing facilities to make it easier to either buy a home or leverage existing equity you might have in a home, or more relaxations that can be made for first-time home buyers. I think it's pretty much it's doable. The question is, what is the downstream impact on actual experienced inflation, right, by the average consumer? And I definitely think you can get growth above a stated, CPI number, particularly given how creatively the CPI is used and kind of manufactured by the BLS. So I think it's definitely doable. The question is just how aggressive and how quickly will these various agencies want to move, and how will they have to package it? I think it was Mel Madison, who's a good kind of macro analyst who's been making the rounds on some macro podcasts recently, was talking about someone like Peter Schiff or some other gold bug, basically saying, I would have been right on all the trades post 08, but I never imagined that the Fed would grow its balance sheet, as aggressively as it did. And, his retort to that was, well, you should imagine it, right? Because that's what they do. So we never imagined that the monetary base could go from, 2 to 8 trillion very quickly and kind of just up and up and up after that. We never imagined in COVID that we could go, multiples higher of that. And of course we did. We're really fully, I think, in the making up numbers phase. And, I think all it requires is just a sufficiently, expansive imagination to kind of get there. The question is just who's going to take it on the chin, which constituencies in the U.S. are going to take it on the chin, and when will they feel the pain? And can, politicians kind of keep that pain at bay long enough to kind of get debt to GDP into a more manageable level that brings us, far enough away from this cliff that some of these issues aren't as dire. So I think it's doable, but it's just a question of who's going to pay for it.
One thing I've been wondering, pretty much all experiences of where we've seen sudden injections of liquidity to try to, fix a problem, drive nominal growth. It always has come after you've been punched in the face, after that there was something unexpected that broke something. Markets reacted significantly. it does seem like they've pivoted their approach from tariffs to, capital accounts and whatnot. But I'm just wondering, do we think that, we'll still see that similar dynamic where they're going to keep trying and maybe they can come up with some creative solutions here, figure out where the money can come from, where the liquidity gets injected into. But is it actually going to come before something breaks, or are they just going to wait until something breaks again?
Yeah, that's the big question. Is something breaking right now? Is this Japanese yield curve blow up the incident that will lead to the big print? And on top of that, as you mentioned, John, you should be able to think creatively about how expansive they can get. But I've always wondered, I've always been wrong. Is there a diminishing marginal return on the print? I think there certainly is a diminishing marginal return when you consider the magnitude growth of each subsequent print since 2008 specifically. But is there a psychological level where it's like, all right, we did 6 trillion in 2020. We're going to do 18 trillion now. Is there some sort of psychological trigger that creates panic? And this is a good segue into your tweet, John, about Bitcoin's performance compared to other assets since Liberation Day. Is Bitcoin, the price of Bitcoin, again, hovering near all-time highs right now, telling us something? Is it acting as a leading indicator for where liquidity may end up in the future?
Yeah, this tweet's a couple weeks old at this point, but it's there are 4 charts here that we can scroll through. But the upshot is you kind of see Bitcoin over these recent time periods, post election day, year to date in 25, and then post the February 2021, like the start of the sell off, which I kind of attribute to the release of Trump's memo, basically kind of indirectly saying that foreigners should repatriate assets and that, that the U.S. doesn't want as much foreign capital here. You look at that, all of those kind of like Bitcoin is generally like in line with or even slightly better than. And again, this is, a few weeks old now, so I'd have to rerun the numbers for how it's been in the last few weeks when we've been on a heater kind of in every single asset class. But in the first 3, like through this more turbulent period, Bitcoin has, either outperformed notably all of these indices, all the major equity indices, or kind of been in line. And then you compare that to the last chart there, all the way over, Bitcoin versus those indices during the COVID sell-off. And you can kind of see like a pretty marked difference in, I was kind of tracing back to like, when did the indices really start to roll over? And I think what I was doing for Feb 14 there was basically like when they went negative for the year. I can't totally remember how I got to that date, but that was basically like what it looked like for when you started to see much more, downside volatility. And in that case, as we all remember, Bitcoin had, its horrific, flash crash, like 50% plus in a day, recovered some, but still like, definitively more downside volatile and shaky than your major equity indices during that time period. You fast forward 5 years and, pretty much what I would say is almost definitely the next most collectively like volatile period that we've had since COVID, where the president came out and said, hey, by the way, I'm completely turning the table over on the global trade system that's been set up for the last 50 years. And I'm doing it in a dramatic way. So similarly volatile time, and Bitcoin held up pretty well. It held up, better on some time periods than the equity indices, or kind of right in line. And so, also coming off of like all-time highs, right? Like it wasn't like the equity indices were at all-time highs and they were kind of mean reverting back below, or back down, and Bitcoin had been like crushed for the past year and it was just kind of getting a bounce, reversal trade. Like, Bitcoin was also coming off an all-time high. So theoretically a lot of air to come out of it, and it held up, as you can see, like certainly pretty well, much better than I think most macro analysts and kind of investors who aren't really looking at the space closely probably would have guessed. And so I'm not going to use the D word that everyone kind of wants to use, decoupling, as it relates to Bitcoin and traditional markets. But I think this is a really interesting signpost for everyone, every investor, every asset allocator around the world to be aware of and take a look at. And I definitely think if you look at commentary from, around the time, there were definitely raised eyebrows among kind of the cognoscenti of, traditional asset management that like, hey, what's going on here? This is definitively not the way I would have thought Bitcoin would have behaved at this moment.
Feels like Bitcoin's growing up. Is it? Not going to say the D word, but it has shocked even me in terms of its relative performance since Liberation Day. And right now, I mean, you have this in the show notes. It's on its longest streak above 100K in its history. 30-day volatility is near a 1-year low. Doesn't feel frothy if we look at the mempool. Fees are in single digits per VByte. Sats per VByte. Google search trends near 5-year lows. And then you don't have this on the notes, but I think it's important to note as well that I believe the amount of leverage in the system is pretty low from a historical level as well. So you don't have too many degen traders going 10 to 50x long right now. So people aren't levering up. It seems like it's performing well on its own right now, which is
yeah. The leverage numbers can move around like a lot, in a 24-hour period. But I think the latest that I saw, showed that as well. So yeah, but it's an odd. I mean, Grant, you and I talked about it a little bit the other day. Like it's an odd time in the market and in Bitcoin, right? Because all of those trends we just talked about, kind of the price action, are all pretty encouraging. We're like a couple percentage points off of an all-time high. Doesn't feel like a ton of, unsustainable froth, but at the same time, like we've got all these tailwinds behind Bitcoin, that we've talked about in the show this year, from the SBR to much greater kind of regulatory, certainty and regulatory embrace of Bitcoin. It's getting much more institutionalized with the ETFs and institutions and companies kind of wanting to adopt it in different ways. And yet when you talk to, people certainly in crypto broadly, but then much more importantly, traditional asset management or kind of, different high net worth circles or institutional investor circles, despite all of that, there's not necessarily like, I think some people are definitely starting to get it, but there's not like a sense of massive urgency to introduce Bitcoin to a portfolio or grow a Bitcoin position within a portfolio, even though I think we all on this call certainly feel very urgent, about expanding our Bitcoin position as much as we can. So curious what you think is going on there, and what does it take to get, certain people, certain institutions kind of to take a closer look when we've got all these tailwinds.
Yeah. I agree with what both of you said. It doesn't seem like the strong relative performance that it's getting like a mainstream bid. It seems like there's strong support, but it's not coming from, your general retail, your mainstream investors that are noticing the momentum and wanting to participate in the momentum. I don't think that, I think that may come later. And that there's support in a bid from other sources. I do think that, like, say the scenarios, that as the agencies and policymakers keep tinkering with their ideas to ignite the economy, if and when something breaks, I still would expect some type of dynamic that we saw in 2020 where, despite there seemingly being some level of decoupling over this shorter period of time, that you would still see a pretty significant decline. Like that's normally what you see, is that Bitcoin, as the most liquid market, tends to lead and tends to move the most dramatically. I think that both of those things, can and likely will happen at some point, that there's likely to be some significant downturn, but also people will recognize that what's happening right now is actually kind of interesting when most, it doesn't seem like to me, are paying attention to it or have noted it yet. I mean, are you really seeing people talk about it on TV, on CNBC? It doesn't really seem that way. And maybe they don't start doing it again until after the all-time high has been pierced again, which we are right up to those levels, just about. I mean, more or less, we're at the all-time high. I don't know how many days we traded above where we are today, but it's probably not many.
Now, look, and if you can pull up, I've got a rough updated version of John's charts from earlier, just a rough year-to-date performance comparison of Bitcoin, NASDAQ, S&P. Threw NVIDIA in there just because it's the darling of the tech world right now. Bitcoin's up 13.7%, NASDAQ down 1.23%, NVIDIA down 50 basis points, give or take. S&P up slightly, 0.71% year-to-date. And so Bitcoin performing extremely well from a relative performance. And I think building on what you were just saying, Grant, it is interesting again the psychology of investors, because we were talking about this earlier this week on our catch-up call, which is like the psychology of investors when they're getting in, just hearkening back to our experiencing raising LTP fund too. And for whatever reason, it's not even like once it passes all-time high, it's when it's rip roaring and well above the previous all-time high is when people really start getting FOMO. And I think it would be productive to anybody out there who's Bitcoin curious listening to this episode to give them the pitch, like, don't wait for that moment. Like, why wait until it's significantly above the all-time high to get in when there's plenty of value to basically take advantage of between here and then?
Well, and particularly, it increasingly just feels like the counter arguments to getting involved, the reasons to stay on the sidelines or to kick the can down the road and think about it later, or to kind of be scared about what could happen, like, are just getting more and more. The answers are getting better and better by the day. The concerns, I think, are shrinking more and more. I referred earlier to the SBR and the regulatory piece, but to the extent that, like, you're sitting there thinking, well, there's a lot of tariff uncertainty and I don't know where the macro backdrop is going to go and what's the kind of go forward system going to look like. Well, in the first place, like, you've already kind of seen an interesting preview of, the market tanking on that. And as we just discussed, like, Bitcoin held up remarkably well during that. And I think there's a deeper reason for that, which is to the extent that we do kind of move into this more multipolar, fractured global trade scenario, there's very clear role in that world for neutral reserve assets to take the place of the U.S. Treasury market as the de facto reserve asset, backing up global trade and as the default place where you recycle trade surpluses. So to the extent that someone, investor, an allocator, a family, whatever, is frightened about kind of the uncertainty that the Trump administration is creating with its desire to kind of upend global trade. I think if you're worried about that, then you should be even more interested in something like Bitcoin, particularly given the growing interest that we're seeing among non-U.S. sovereigns in owning Bitcoin, building their own strategic reserves, getting into Bitcoin mining, some of which we've talked about on the show, much of which has been kind of publicly discussed in the last few months. But all that is just to say, the last thing probably remaining holding Bitcoin back to some degree right now is uncertainty, policy uncertainty, et cetera, as it relates to trade. But if that's a fear for you, then Bitcoin makes even more sense in the world where, that really goes south.
Another interesting dynamic is, like, the question we always get is, well, if I believe in Bitcoin, like, why should I not just buy Bitcoin? Like, do you expect to outperform Bitcoin? Like, we all believe that Bitcoin has this dramatic upside. How will you actually outperform that versus I could just hold Bitcoin? And one part, I'd say it's like a tertiary answer, is that most people will not outperform Bitcoin, even if they're just holding Bitcoin, just because of the psychology of it. They will decide to buy the Bitcoin when it's already too late to have bought, and they will decide to sell it when it's down, when they shouldn't sell. It's a very hard thing to do. The time people should be buying is right now, as opposed to in a few weeks or a few months, whenever it starts really making a run. But the psychology is a tough thing for, the average person to grapple with. And as a consequence, most people probably will not perform as well, like in line with Bitcoin, as they otherwise could have.
Yeah, psychology, especially if it's your first cycle. Is I'm sure you guys felt this too, but in your first cycle, you get in, buy a Pico top. I did that in 2013. Panicked a little bit as it fell to 200, and it takes a lot of muscle building. But John, to your point, in a world of uncertainty, I think the asset that makes the most sense to hold is an asset that revels in uncertainty, because it provides the world with a very certain rule set and protocol that you can be certain is going to operate in a particular way, despite anything governments or corporations or any other actor in an economy may do external to the protocol. In a world of increasing uncertainty, you want a dumb protocol that can provide you incredible certainty while the world begins to reset from a geopolitical and macroeconomic landscape.
Yeah. And I mean, as just one example to dig even further into that, just to put on people's radar and flag, Logan, if you pull up this tweet from Michael McNair, we don't have to get into all of the arcana here because it's very complex and goes above my pay grade as it relates to kind of tax policy. But this guy's a fund manager who's flagging a recent headline on the U.S. wanting to retaliate against unfair foreign taxes and potentially by levying new taxes on foreign holdings of U.S. assets. So whether that's primarily treasuries would be the target, but also I believe foreign holdings of U.S. equities. Previously, in prior to 1984, these were taxed, and then various changes were made to make them tax exempt by a lot of foreign holders. And I think this is interesting because to the extent that they want to go this way, this looks a lot like the user fee concept that Stephen Myron proposed in his Hudson Bay Capital paper late last year. Myron now runs the, I believe, Council of Economic Advisors for President Trump, and was kind of one of the architects of kind of re-architecting concept for global trade and global capital flows. But this basically, something like this, like no idea if what this guy's proposing is exactly the direction they're going to go, but you're starting to see these trial balloons floated about something hitting the capital account side of things. Like for the last month and a half, we've been focused on the current account with the US's trade deficit with the rest of the world. The flip side of that is the massive capital account surplus that we have as foreign trade partners recycle their trade surpluses into U.S. assets, primarily treasuries, but also equities and property. And so to the extent that, we're moving away from targeting, the current account piece as aggressively and moving more toward the capital account side of things with something like this user fee concept for U.S. assets. There are some obvious knock-on effects there, right? Like that's kind of the thing I was referring to earlier with, if you're fearful and uncertain about what Trump wants to do with kind of his policy as it relates to global trade, here's another thing he could do and potentially a reason to be uncertain about what's going to happen. But the most immediate knock-on effects of something like this would be, okay, at the margin, foreign trading partners have to shed or are incentivized to shed to some degree U.S. Assets to help kind of then mechanically on the other side lead to or help support a closing of or a decline in our trade deficits. But then that means, Grant, to your point earlier, air comes out of multiples on U.S. stocks. We're still sitting at very high multiples on major indices historically. So there's room to go there. There's incremental demand potentially to come out of the U.S. Treasury market and mortgage-backed securities and other kind of key pieces of U.S. fixed income. So if that happens, like if something like this flows through, then okay, well the first effect is you likely need some sort of stimulative activity on the other side to offset. And maybe, Grant, that's where things start to break, and that's where you get your next alphabet soup facility for the Fed or other agencies to kind of step in and make up the difference to keep asset prices elevated, since they are on the margin the main driver of U.S. tax receipts. And so that's one piece. Like, to the extent that we want to move in this direction, yeah, maybe that creates uncertainty, maybe it's scary, but Bitcoin's the fastest horse in the race where the Fed has to come in and kind of support multiples to offset this. And the second piece is, the wealth that's exiting U.S. assets in a world like that is going to be looking around for alternatives. And, you could go into maybe you want to go into Chinese assets or Japanese assets or European assets, but a lot of these markets have their own capital controls, and it's not super easy to get capital in and out. And you probably, if you're trying to move a decent amount of capital as kind of a more, a member of like the developed world, if a Western leaning investor, like you probably aren't looking to go deploy it aggressively into, territory controlled by the CCP. And so what you might be more interested in is something like, neutral reserve assets like gold or like Bitcoin. So all that is just to say, any world where the trade deficit is closing, whether because, of something like the tariff regime that we were trying for the last couple of months, or because of dynamics that, force the capital account surplus to come down. Both of those, I think, are going to have pretty clear knock-on positive effects for assets like Bitcoin. So to the extent that you're worried about that, it might make might make sense to get some Bitcoin just in case we go that direction.
Yeah, and this is particularly interesting because I think that's one of the points of clarity, at least in my mind, over the last 6 months, is really digging into the dynamics of Triffin's dilemma and how all this works in terms of supporting asset prices here in the United States. And essentially you flood international markets with dollars for their cheap labor, but then they take those dollars and reinvest them in our equities, real estate, whatever it may be. And something like this would completely throw a wrench in that. And I mean, to that point, and going back to, is this 3D chess is playing out exactly how they imagined, or are they getting punched in the face? Like, let's run with the idea that the Trump administration, Scott Bessent specifically, is basically saying, I don't want to say game over, but things need to change. And we're going to sort of throw conventional wisdom and the playbook that's been used for the last 50 years out of the room and just let things do what they do. Sorry, somebody, and I'm just setting up for an event tonight. Let things play out. It's going to scare a lot of people, but we're going to reset on the back end, which brings us to the topic of the Genius Act and stablecoins. And there are many people surmising that there's been so much focus on a stablecoin bill here in the United States because the stablecoin industry, or complex, however you want to describe it, is something that Scott Bessent and the Trump administration plans to incorporate into this transition and use it as a mechanism to soak up a lot of liquidity and prop up the U.S. Treasury market specifically.
Yeah, it's interesting how the conversation shifted. There was a lot of focus on Bitcoin and Strategic Bitcoin Reserve during during election season and kind of in the lead up to Trump's inauguration. And, certainly we moved forward with that in a way that I think was impressive, and probably I think should silence some of the people that said, that was all entirely fluff and it was never going to happen. The executive order we talked about in the last episode, I think was pretty meaningful and pretty, it shifted the Overton window pretty significantly relative to what any of us probably would have expected a year ago. But the focus point, Marty, to your point on, the conversation in Washington after Trump's inauguration definitely seemed to shift much more toward kind of a stablecoin regime and something like the Genius Act, and getting that passed and creating some sort of, defined market structure, whatever that means for stablecoins in the US. It's, I think the untold or undiscussed, or very slightly discussed piece of that that no politician will ever really come out and say on the Senate floor, but seems to be like on the margin of the most important piece is the incremental valve of demand that can create, right, for U.S. Treasuries, especially kind of short dated notes and bills. There was the Treasury Borrowing Advisory Committee put out a report like late April, early May, with some really interesting slides I recommend people go look at. And Logan, if you want to pull up one of them here, we can just point out one thing on it. But basically, it's again, as it relates to like quiet parts being said out loud, the analysis kind of runs through all the different kind of dynamics behind stablecoins and how they work and things like that. But as you kind of scroll through, on the left-hand side of this page, page 11 of the report, there's a very kind of explicit declaration that, and also, by the way, if stablecoins experience exponential growth, the demand for UST should be correlated. In this case, likely at the expense of bank deposits. And there's some sensitivity math in here kind of showing, what a growing stablecoin market could do for demand for US Treasuries. And so, it certainly looks like there's a healthy appetite to for this to be another, rabbit to pull out of the hat for creating incremental demand to sop up UST issuance. So I think, it's of a piece with everything we've talked about, right? Like, I think there's much less real concern about kind of encouraging quote unquote payments innovation, and much more about, recognizing the what this could mean for bringing in yet another lever to soak up incremental issuance.
Yeah, I agree with that. I think, there's clearly some potentially more obvious financial motivations for them to focus on this versus like anything Bitcoin related, put aside actually the US government holding a Bitcoin strategic reserves and the positive benefits that could come from that. It does seem like they're likely motivated by the impact, stablecoin regulation could have from them from a financial perspective. But I also think that it's just it's easier for them to conceptualize, to think through like the framework for just thinking about the direct impact on the US dollar and stablecoins. That they can fit into their box and think about, okay, well, there's assets they need to custody and it's the US dollar versus, something that requires an entirely different line of thinking for Bitcoin, and how do they come up with the right approach to that? It feels to me like it's a combo of both, where they naturally are gravitating towards it because of perhaps some financial motivations, putting aside like the long-term benefits of Bitcoin, but also because it's maybe the easier thing, the more obvious thing to them to focus on versus the one that matters more in Bitcoin.
Yeah. They're all hot and bothered over stablecoins right now. And I think it is just to soak up that treasury demand. And that chart you had up, I believe Tether alone had $94.5 billion in short dated treasury exposure. I believe the average duration was less than 3 months or 30 days. But I think it's important to make clear to anybody in the audience listening to this and thinking like, oh, is there a massive opportunity here for me? Probably not. Like really, like the people that are going to benefit the most from this are the select few stablecoin issuers that get anointed the ability to play ball in the United States and more broadly outside the world. And then obviously the Treasury itself, because it has significant demand from these buyers moving forward. We've seen companies like Stripe announce that they're integrating stable coins into their platform, creating some marginal efficiencies from a cost perspective. But in terms of like game changing sort of opportunity to realize a lot of value accrual, I don't think there's really many things in the private market outside of issuing a stable coin or maybe incorporating them into your business to save some cost on interchange fees or cross-border transactions. I think in the long term, stablecoins, I'm going to call them a distraction, but they're certainly noise compared to Bitcoin, which is stablecoins have the inherent problem that they're operating on a US dollar system that is being run by a central bank and a federal government that is addicted to debt. And so the form factor by which the dollar is able to move changes a bit and create some efficiencies, but the root cause of why people are adopting Bitcoin in the first place is because the dollar is being continually debased. And even if stablecoin issuers drive up demand for U.S. Treasuries orders of magnitude, it does not solve that core issue, which Bitcoin does. So point being, in terms of signal, in terms of opportunity to take advantage of insane value accrual, I think the signal's squarely on Bitcoin. And I think over time, based off of everything we've discussed on this discussion, it's going to become more and more clear that it's going to be extremely advantageous to hold a neutral reserve asset form fit for the digital age moving forward. Yeah,
for sure. And I think, if you're imagining, to your point on Tether, Marty, and the idea of the few incumbents that are likely to capture most of the market, I think that's spot on. If you're imagining some bright stablecoin future where there are thousands of different stablecoins proliferating and everyone is issuing their own, and you can issue your own stablecoin and you can be Tether and you can benefit from the same kind of dynamic. I think it just misses. I think that's, you're gonna have a bad time if that's what you're banking on. It misses that kind of future that you're imagining is just a world of is basically reintroducing barter, right? It's coincidence of once, non-coincidence of once as a service. And I think what people want, right, is if I accept Tether, I don't want your stablecoin that I didn't have to convert to Tether. I want you to give me Tether. And if you have a balance of Tether, you want to pay with that balance. You don't want to have to convert it into something that I want to receive. So from a payments perspective, like there is a natural gravitation. We've talked about this before with, the savings case for Bitcoin. In the interim, there's a similar dynamic plays out, I think, with stablecoins as well. There's a tendency toward a couple issuers, maybe even just one issuer ultimately, that can, build up the network effect and of having like the database essentially that everyone wants to be, a part of. And to the point on efficiencies, like, maybe you're getting efficiencies for now, but as long as stablecoins are leveraging, non-Bitcoin blockchains, like it's just a cat and mouse kind of whack-a-mole game, jumping from one blockchain to the next as usage of this stuff really ramps up. There will, and we've already, seen this, fees spike on chain on these different blockchains, and you have to move over to kind of the next one where fees are lower and kind of rinse and repeat ad infinitum. Ultimately, it seems like the long-term, process here, the long-term outcome is you move away from blockchains entirely, and you just kind of have a database, right? Tether has a database, USDC has a database. That's really what we need to get kind of max efficiencies. If you're not optimizing for trustless, fixed supply digital cash, that solves the double spend problem without a third party intermediary, which is what Bitcoin is. So if you don't need that, then you should probably just move to a database. And so it seems like that's the long-term, play here. And in that world, I think there will be the the offshore dollar, like the kind of the gray market dollar substitute, maybe that's Tether, that kind of wins out and gets huge demand from, from international markets. And there will be the onshore highly KYC'd, dollar that is maybe used in, in US and our allies, jurisdictions. Maybe that's USDC, maybe that's also Tether. I don't know, but all that is to say, I think any thesis that involves some massive proliferation of all these different kind of stablecoin technologies is probably headed in the wrong direction. And I think this is a market, again, similar to Bitcoin in many ways. It's a winner take all or winner take most type situation that we're looking at here.
And while we're on the topic of stablecoins, USDC specifically, great segue into the deal breakdown section of the show. I know you don't have this on the show notes, but it has been floated the last couple of days, the potential for Coinbase to acquire Circle and fold them into their operations. They've had a pretty tight partnership, I believe, with some degrees of exclusivity as well up to this point. And Coinbase has been maniacally focused on building a brand and some would argue a regulatory moat here in the United States. Circle's been running in parallel, trying to do something similar in the world of stablecoins. I think that's a lot of what the stable coin bills that are being discussed in Congress revolve around right now. It's conversations about who should be able to do it, compliant USDC or the pirates that are Tether. What are your thoughts on the potential of Coinbase acquiring Circle? Makes sense to me.
Yeah, I didn't know if Grant was burning to answer, but I agree. Directionally, I think that makes sense. I think when I saw the headline floating that rumor the other day, my knee-jerk reaction was essentially like, oh, that hasn't happened yet. Like I kind of know that they're separate, but I've always just kind of thought that was kind of directionally where it would go. So yeah, I wouldn't be surprised at all. Clearly, it's a business model that it's a good gig if you can get it for now, and wouldn't be surprised for the largest player in kind of U.S. crypto markets broadly to be the one to take that swing.
On another note, Coinbase in the news the last couple of weeks too for a security breach. I think this is actually a really good topic to touch on, particularly in the context of things that we focus on a lot here at 1031, which is dealing with companies that have to handle KYC, AML information, how to best do that. It seems like Coinbase outsourced a lot of that process to third parties in countries outside the United States, and the individuals running those support jobs turned out not to be as trustworthy as one would like them to be, considering that position. Less than 1% of Coinbase users' data was sold to nefarious actors who were successfully able to convince some of these customer support contractors to give over the information. We don't know exactly what customers, but one would have to imagine that if a nefarious actor is targeting Coinbase users, it's probably those that have a lot of Bitcoin or older users who are more susceptible to phishing attacks. But this is a big problem. KYC, AML, data that these companies are forced to collect and ideally secure properly. Seems like Coinbase hasn't done it in this case. And I think a lot of the reason is just they've been spread thin. They grew a lot, have a lot of headcount, and they sort of outsourced a very vital part of their business, particularly the trust building part of their business, to somebody that turned out not to be trustworthy.
Well, I think it's difficult for us to point and laugh at Coinbase and say, see, they didn't do it the right way, and sort of assume or imply that maybe there's companies that are doing it the right way in the Bitcoin ecosystem, which there very well may be, but it's just a fact of life that if you want, if you are touching, users' money, and there's regulations involved. You have to, I mean, we don't like KYC, AML, but you have to do it if you want to comply with the law. And it's fairly common to outsource this. It's not like Coinbase is the only one doing it. We've seen various data breaches within the Bitcoin ecosystem in the past as well. And there's vulnerabilities from working with any partner. There's even vulnerabilities if you are running the KYC AML program in-house. But for most of these companies that are building technology, you can make a strong argument that that's not, that is not their bread and butter. Like, they are trying to build certain technology, and there are best-in-class services providers that provide KYC services to companies, and that do this across lots of different services providers in the space. That can create a honeypot, obviously, but I think it would not be correct to imply that Coinbase is out there doing something that others are not. It's an unfortunate thing that has happened, will happen when you're dealing with customer data, and that's why it's really important for users to just be aware of the data that they're providing and be aware where their vulnerabilities are. If they're holding Bitcoin with a custodian, that could be at risk, and that's why we always recommend, if users are comfortable with setup and custodying themselves or having some type of collaborative custody model, that's the best way to custody Bitcoin, because either way, there's going to be attackers that are trying to get access to your data, trying to get access to your Bitcoin.
Yeah, I mean, I think the tough thing is, like, given the nature of the laws right now, there really is no way to do it right, because there's just the whole, the requirements are such that you have to put, if you want to interact with these services, data into a centralized database, and try as they might, even if everyone in all these industries is well intentioned, it's impossible to keep it. It's just been proven it's impossible to keep it 100% secure. So I think the solution that we have right now, other than, lobby for, change to the Bank Secrecy Act or things like that, is, Grant, to your point, something like collaborative custody, like what's offered by Unchained, or what AnchorWatch offers, with insured custody, soon to be, some multi-institution custody options, but creating basically frictions for the way that you hold Bitcoin, such that, you're not just a SIM swap away from losing Bitcoin, or you're not one social engineering phone call away from, signing away your Bitcoin, or, you log into a fake portal from an email, and then you have, indirectly authorized movement of funds. You want to put a lot of frictions basically between you and, any significant amount of Bitcoin that you're holding, so that you have much less likelihood of kind of getting emotional, getting a social engineering kind of phone call from somebody and emotionally making a big decision. It should kind of be hard to move any kind of meaningful amount of Bitcoin, right? And so one of the services that a company like Unchained, a company like AnchorWatch can offer, is adding those layers of useful kind of institutional grade friction, private wealth management, white glove service type friction to, movement of your holdings, such that it's not super likely that, you can easily get phished or easily socially engineered, or, easily have an account compromised, because you've got so much private key material, ideally, geographically distributed in kind of different offline spots. So I think that's a huge mitigant, is services like that just make it harder to, go through something like that.
Yeah. And I know we didn't want to talk about it, but the op return kerfuffle in the Bitcoin world, I'm pretty sure many of you listening to this are probably blissfully unaware of this whole debate that's been going on, but it has taken away from other conversations that I do think are very important to be having right now, especially in regards to this specific topic, which is the idea of potential covenant soft fork, whether that's op check template verify or others that are being proposed that would make it significantly harder for people to successfully socially engineer somebody to giving up all their Bitcoin, essentially creating spending conditions and fallback options for Bitcoin, that if a nefarious actor is successfully able to get access to your private keys and begin moving Bitcoin or socially engineer you to move your Bitcoin, something like covenants would create conditions that'll give you a fail-safe to move that Bitcoin to another address as it's in transit. So something to be aware of.
You heard it here first. 1031 is trying to change Bitcoin.
Not trying to change it. I think it's a worthwhile conversation. If you're worried about something like this and you think it's a big enough problem that it makes sense having conversations about incorporating something new into Bitcoin. That's how I'd frame it. But last on the list, deal breakdown. Bitcoin Treasury companies hot right now. Metaplanet over in Japan. We were talking about this in our group chat earlier. Is it sort of this flight to safety asset that exists in Japanese equities markets as their yield curve goes crazy? Metaplanet stock has been going up pretty rapidly. I believe it got halted twice today during Japanese trading hours, trading around $3 billion market cap. Obviously, we have the emergence of Nakamoto 21, Strive Asset Management, announced that they will be going public and applying a sort of unique Bitcoin Treasury strategy, which is to go out and find companies that are trading below book value, take them out, or not take them out, acquire them, turn their cash into Bitcoin. What are your thoughts on this trend of Bitcoin Treasury companies flooding the market? Is it a flash in the pan, or is there some staying power with this strategy?
I can start. I mean, one thing that I've found interesting, like if you think about it over time, over the last several years, I mean, when we started 1031, 2020 timeframe, a lot of the pitches and the inbounds that we got back then, 2020, 2021, even 2022, was like every pitch, like 9 out of 10 pitches that came in inbound through the website were founders that were looking to build like a mining company, right? They're like, well, we got some TradFi people, we got some energy people, we've got low cost energy, and we've got direct, attractive access to ASICs, and we're going to go do, we're going to be the next greatest Bitcoin mining company. We did hardly any of those deals. In fact, like any inbound that comes directly to our website, like that's generally a no for us. And there's a reason why we don't have an intake form on our website for founders to reach out directly, because that's just not the way that we make investments to begin with. A cold inbound to the website's not really going to work for us. But the point I was making is like everyone wanted to be a mining company. Very few of those were successful. And it does feel like right now there's just a massive influx of these inbounds that are coming for, we're going to create the next Bitcoin Treasury company of Brazil or of Australia, or we're going to pursue the MicroStrategy play. I don't think that it can only be MicroStrategy that is successful. I think MicroStrategy, their strategy, or strategy, I guess their new name, has evolved over time. And I think they didn't really determine what they were and what they were doing, except over some trial and error. And I don't think that they're the only one that can be successful. But I do think that it feels very trendy at the moment. And I personally don't get too excited about it. When the next inbound comes in and says, well, we're going to be a Bitcoin Treasury company. To me, it's like, I like finding founders and companies that are carving out their own path and doing something different. Now, there might be a way to do something different with Bitcoin on your balance sheet, with a strong Bitcoin Treasury. Say you're building, Bitcoin-oriented financial products, or you're operating in the Bitcoin space. Like, that's clearly part of our thesis, is that there are interesting ways to participate and drive growth in the ecosystem, and to do so with Bitcoin on your balance sheet. So I don't personally get excited by the next announcement of, the next treasury company that's going to be doing something. There may be ways for them to differentiate themselves relative to what others have done in the past. But I also think that I don't think it's really played out. Like, I don't think it's saturated really at this point. Like, it still feels like we're pretty early. You've started to see a lot of these announcements happen of companies that are trying to go down that path and announce a Bitcoin treasury strategy, but we haven't seen any that just haven't worked out, that have blown up. So I think we're still in the early days, and likely with the Bitcoin conference happening next week, I bet a large percentage of the announcements that people are waiting to make at the conference are going to be a lot of Bitcoin treasury announcements. So that's some initial comments. Curious how you guys think about it.
Yeah, I mean, on the point of blowups, it's too early to say kind of that any of these are going to blow up, or that any of them are going to work out. I mean, a lot of the ones that have been announced are still like, the deals haven't even closed yet. So it's like, let's see how it kind of comes to market. And then you've also got, your kind of struggling companies like circling the drain in some random industry that, put out their press release that they've initiated their Bitcoin treasury strategy, and they plan to buy, $1 billion of Bitcoin or some crazy number. And then you look into the details and it's like, well, at our next board meeting, we are going to initiate discussions of ideating on how we could go about acquiring Bitcoin for the company or whatever. Right. And so there's some of the press release games going on as well with some of these, smaller companies, that's reminiscent of, Long Island blockchain in 2017, Long Island Iced Tea, adding blockchain to their company name and trying to get a little pop and a benefit from interest from that. But yes, I mean, it's too early to really kind of pass any judgment on any of them. I do think it's like, Grant, to your point on Bitcoin mining, something that we've talked about for a long time is that capital efficient Bitcoin companies that can generate sats flows are, basically much more capital light versions of Bitcoin miners, right? Every company effectively, you wrote about this in our launch piece for 1031 back in 2020. Every company, essentially that can produce net economic value and stack Bitcoin with it, or spit off cash flows denominated in Bitcoin, is a Bitcoin miner. So everyone wants to be like, even Bitcoin miners want to be necessarily as capital efficient as they can be, because that's how they actually stay alive. But every company wants to, be effectively a more capital light, more capital efficient Bitcoin miner, which is just to say they want to have the highest Bitcoin denominated returns that they can. And I think there's definitely something interesting that a lot of people in the space have grabbed onto, which I think is fair and legitimate, that right now, given the state of capital markets, traditional fiat capital markets, one of the most capital efficient ways to acquire as much Bitcoin as possible, or to produce, sats flows. It's not really sats flows because there's not any sense of, distributing them yet. But one of the most capital efficient ways to get access to Bitcoin is to become a Bitcoin treasury company and go tap the public markets, go tap convertible debt markets, go use these different instruments that are kind of trapped in fiat land and can't necessarily buy Bitcoin directly, but might have appetite to get exposure to Bitcoin in some way, or find investors that, are actively looking for, levered fiat plays on Bitcoin. Clearly there's a lot of demand for that as well. And so, I think it's no surprise that people would grab onto the fact and kind of realize that one way to be a very capital efficient Bitcoin miner is to mine fiat from the public markets and, build a capital structure that you hope is sustainable and can last through the cycles, to allow you to accumulate Bitcoin on net year on year, and, grow shareholders' exposure per share to Bitcoin over time. So that's not surprising to me. And I think a lot of it is legitimate and commendable for that reason. I think it's also an interesting, manifestation of Pierre Rochard's speculative attack, that he wrote about from over 10 years ago. Basically, to get back to our topic at the top of the show, it's a carry trade, right? It's go find cheap capital and deploy it into, a higher returning project. And historically, that's been, you can borrow at low rates or maybe issue equity in the public markets if your company is trading at some crazy, PE multiple, and go buy data centers or go buy, buy another company that you can bolt on into your company and that, that'll clear a certain cost of capital for you. And, this is no different. It's finding cheap capital and going to try to deploy it into the highest returning project that there is out there. Right. And, the meta planets of the world, the strategies of the world have made the good point that the deployment cycle is also very, very quick here. It's not like we, go get cheap capital and then deploy it into a factory that takes a year to build, and then it takes another 6 months to ramp up and actually be profitable on like a, a net unit economics basis. It's, I raise the capital and then tomorrow, basically I can go deploy it entirely into Bitcoin, into slug of Bitcoin if I want, right? So I get the deployment immediately and kind of rinse, repeat. And so there's a lot of, I think, rationality to that. There's a lot of, like I said, a lot to recommend it. But it's very possible and I think very likely that not everyone is going to do it as conservatively as Saylor has been able to do it. If you look at his balance sheet right now, he's reasonably under leveraged relative to the Bitcoin that they have on the balance sheet. Even if you haircut, the value of it pretty significantly, he's not dramatically over his skis in terms of the debt burden. He's taken advantage of, the NAV multiple that they have to, whether you think that's a logical thing or not. He's doing exactly the right thing of issuing more equity to go pump it into Bitcoin and further shore up the balance sheet. But not everyone's going to have that benefit. Not everyone's going to be able to, to get to that point. And I think there are a lot of people who are going to use. I can't remember who said it, but someone in the Bitcoin community said, everyone thinks leverage is a time machine to being an OG. There are a lot of these companies out there that I think, they're going to think that leverage is a time machine to being, Saylor. And I think there will be some companies definitely that are in for a rude awakening on, managing the strategy appropriately through all the volatility. But yeah, I think it's the first inning. I don't think we're close to the eighth or ninth inning yet.
Yeah, I completely agree there. But I think there's got to be like some sort of Pareto distribution of network effects that take hold, and economies of scale will benefit the winners massively in the long run. And I do think first inning is going to be a massive trend this cycle, I imagine. But to both of your points, Grant, it does feel very trendy. It's which makes me uneasy. I just had my caveman been in this game for 12 years, alarm bells ringing. This feels very trendy. Somebody's going to blow up somewhere down the line. And then long term, Michael Saylor's explicitly said this in one of his shareholder meetings. They think that MicroStrategy is going to become a Bitcoin bank of the future in its next chapter after its accumulation phase. And if you just look at how banks trade, very close to their book value. So I think these multiples can expand to the point of what's the word I'm looking for? It's the point of absurdity. For a time, but in the long run, I think they'll compress to book value. And I think we're just got to see animal spirits play out in these markets. But Logan, bring up the tweet, and to what both of you said, I think, Grant, we align very well on the point. The thing that really fascinates me in terms of actually bringing value to the world in terms of productive goods and services is profitable operating businesses that roll profits into Bitcoin. I think this is way more exciting. And I don't want to say worthwhile, but it's something that makes it easier for me to get out of bed in the morning and focus on is what are the companies that are providing value to the world, doing it efficiently, getting profits, funneling that into Bitcoin, scaling up the strategy. And to that point, there's never been a better time in history for companies. So taking this to the other end of the market, we've been talking about publicly traded behemoths, speculative attacking the cheap credit in the fiat world. Many of you listening out there, particularly if you're younger, which I know there are a few of you out there, and and instead of trying to hop in a time machine using leverage to become an OG, like there's never been a better time to start a company that cash flows quickly with 2 to 3 people. Bitcoin, particularly if you're leveraging AI, I think Bitcoin and AI will be the most powerful sort of combined force of this decade if you leverage both of them correctly to build a business and then make sure that you're storing the value that business creates in a hard asset like Bitcoin.
Yeah, I mean, fundamentally, there's really at a high level, 2 ways to add Bitcoin. It's some sort of capital transaction that you do, like external to your business. You raise equity, you raise debt, you raise some sort of convertible security, what you're seeing with these Bitcoin treasury plays, or it's just adding it internally with generating cash flow or sats flows. Ironically, even though it feels very trendy and people are just, they're trying to replicate the success that, they've seen others have with this strategy. To John's point, it also does make sense from a corporate finance perspective. Like, say you have Long Island Iced Tea 2.0 that says, you know what, we're going to become a Bitcoin treasury company. They're allocating capital to something that appreciates at 30%, 40%, 50% a year, whereas their underlying base business probably wasn't doing that. So from a corporate finance perspective, it likely is better in the long run for a lot of companies to not be allocating capital to their business and instead consider holding it in Bitcoin, basically saving their capital until you have some normalization of the return on invested capital from a business that you're building relative to the return on capital that you have from Bitcoin, or said maybe a slightly different way, it's just the opportunity cost of Bitcoin. More will appreciate that over time. So, ironically, it likely is a good thing for more Bitcoin treasury companies to exist. It's sort of, again, to John's point about the carry trades, it's taking advantage of an arbitrage that exists right now in the public capital markets for demand for these types of securities. The thing we have to watch, and especially for any company that's pursuing that type of path, is, are they taking on any leverage, whether it's direct financial leverage or implicit leverage somewhere in the business that could, blow themselves up some way, because, then you're not actually creating long-term value. You're just destroying it quickly.
And I wonder at what point do enough of these companies come to market that it dries up the cost of capital? Because right now you have so few options to go run the strategy with. Like, at what point are there enough Bitcoin treasury companies where the liquidity providers are like, all right, like, you guys are going to have to bid for these dollars now? Or does that not even?
I mean, maybe, like, the thing is, to also to our earlier conversation, like, there's so much fiat sloshing around, and there's probably going to be a lot more, like, and kind of just the cost of capital, almost like definitionally, to what we were talking about earlier with, Bessent's, the Bessent clip, like, the cost of capital in our system, like, almost definitionally has to be suppressed below, like, kind of what the rate that would be market clearing otherwise. And so I think there's always probably going to be, like, not at every point in the cycle, and not at every year necessarily, but, like, over the stretch of 5, 10 plus years, like, I think there's always directionally, like, a fiat bid available for virtually anything that can spin a story to, especially public markets. I don't know that, like, access to capital necessarily, or the cost of it would be the constraint. But I think, Marty, to your earlier point, I do think there's a mind share saturation point where, the top, I don't know if it's the top 2 or top 5 or top 10, whatever, but the players that can get out in front the fastest and build up the biggest Bitcoin treasuries, like, I definitely think, there's room for more than just MSTR, but whether it's 10 or 20 or whatever, there's not room for probably 1,000, right? There's going to be a Pareto type, I think, distribution of consolidation of attention toward the companies that can build up, that can get to scale the fastest, and that can get to the biggest Bitcoin treasuries before everybody else. Because there will be, I think, liquidity begets liquidity, and the larger capital base will beget yet more investor interest and yet more ability to go invest more capital into those businesses, potentially with depending on each company's capital structure, but potentially with better terms and less volatility and more assurance of kind of repayment of these different instruments. The bigger the capital base is. So I do think, like, as we go through this cycle, there is an advantage to being fast and big and early, obviously, to be balanced against having a sustainable capital structure that's not going to blow up at the first sign of a bear market. But yeah, I do think that that'll be like the point of diminishing returns. I think is more on like the investor mindshare side. Like at a certain point, you're going to ask yourself, why should I give money? Why should I allocate capital to this vehicle in your Bitcoin treasury company, number 85, when I could just do the same with MSTR or Metaplanet or, pick your other company that's out there right now. So that's where I think I see it tailing off in that way over time for sure.
I could see how, perhaps there could be more of these treasury companies that exist in different jurisdictions, different geographies that operate with their own financial regulations, that, there are securities. There are walls set up between geographies from a securities perspective. So that likely is a reason why there's specific demand for Metaplanet versus, other Bitcoin treasury companies from local investors. So I could see that being the case more so than you might see with Bitcoin companies itself. Like when we think about our philosophy of investing in the ecosystem, we have backed, we try to back the leaders and their respective businesses, like a Strike, for example. And we like Bitcoin is an open, interoperable network. So, there are local regulations from a, money transmitter perspective that you have to deal with, that Strike as an example has to deal with. But theoretically, it can operate across the globe because the network is open and interoperable. So we like the idea of backing a Strike who is a clear leader versus, the second or the third, this Strike of, name your country in South America or Europe or Australia. And so I could see how, because of the dynamics with just traditional financial markets and securities, perhaps that allows for the proliferation of more Bitcoin treasury companies. But it'll be interesting to see.
It certainly will be. If it's the first inning, we've got a lot of game left to watch it play out. So we'll keep all of you abreast of the Bitcoin treasury play as it unfolds in the coming years.
What I will say on this is, as it compares to last cycle, I'm pretty sure I would much rather have, the degens be wearing suits and be kind of working on, Wall Street in some way and doing kind of display.
Be careful
versus going. No, well, there are a couple of considerations with it, but I think I'd rather have this than the 100x levered long offshore, FTX, BitMEX type degen who can give us probably a much faster, bigger FOMO run up, and is almost that is certain to kind of pop and give us an 80% decline in short order as well. I think you can build things with some of these structures that can last and build up a little more base. I think you're more likely to be able to do that with some of these structures than you ever would be with the market structure that we've had kind of up to this point. There will definitely be blow-ups, and maybe the kind of cumulative amount of these types of companies coming to market, all making terrible kind of financial decisions. Maybe that collectively, becomes a huge headwind that the market has to absorb. But if you have companies that look a lot more like MSTR. Again, not that MSTR is impregnable or bulletproof, but if you have companies that take an approach to leverage that they have taken thus far, and that's what these plays look more like, then I think that's probably a better position to be in from a kind of externalities on the rest of Bitcoin holders perspective than everything we were dealing with in the last cycle. But time will tell.
That's a good point. Time will tell. Gentlemen, it's been a great catch up. I feel like we covered a lot. There was plenty to talk about. Not forcing the content. It's good to get the people an update on what's going on out there.
Yeah, we provide artisanal alpha. So just we don't mass produce the alpha. It just comes out whenever the moment is right.
Artisanal alpha. I like that. We have to test that out as an official slogan of the podcast.
We need it on hats.
Small batch alpha.
Small batch alpha.
Exactly.
All right, gentlemen. This has been great. We will see we will see you all when we put together a menu of alpha to artisanally deliver to you at some point in the future. That was your alpha for the week.